days. Let's do all of this with Jay Hatfield, Infrastructure Capital Advisors, Portfolio Manager, and Chief Investment Officer. Jay, what do you make of days like today?
Well, first of all, Taylor, thanks for having me on. Actually, I think that the market reaction is pretty efficient, really, in that this is clearly new incremental bad news. It will affect leisure and travel. It is negative for oil. We think oil is going to go back into its summer range, 65, 75, because we have been bullish about next year's prices because of the recovery of international travel. If this isn't, in fact, a very vaccine-resistant virus, then that's going to hurt travel. So you see oil way down, you see energy stocks down 7-8%. What we haven't gotten yet, which we think we might get next week, is a rotation where people start buying the Apples and the Amazons, and we think that'll stabilize the market. So we agree actually with one of your prior guests that we just see this as being range bound. There's a lot of resistance at 4,700. This is bad news, so we're, dropped 100 S&P points, but seems like a rational digestion of the new information.
How, though, are you thinking about liquidity, maybe the lack thereof, and any sort of overreaction given some of the thin trading that we also see?
Well, I think that, most active managers, watch the futures, big hedge fund managers. So it's not like they're just sipping their lattes and not buying puts. So I think that this is like I said, the reaction is relatively efficient. I think that most of the big players are involved and are putting their hedges on, and that'll help stabilize the market. Because when the VIX rise, that means obviously people are offsides, they're buying puts, they're taking down their implicit exposure. So once you get to that level, which we probably achieved most of it today, then you could either get a bounce or at least a rotation next week. So I don't think that, I wouldn't overemphasize the lack of liquidity, because when the markets are really bad, if there's just some small news, then maybe that's inefficient, but if they're really bad, everybody obviously can trade remotely. I'm in Midtown, but everybody can trade remotely. So it's easy for big hedge funds to express their views through the option market very rapidly. And that's why you do see these big liquidations. That's why utilities are way down as well.
Talk to us then about the rotation that you were seeing, not only within coming into this day, this big sort of reflationary rotation that was underway, but now maybe this rotation back into big tech. Where are we in that rotation?
Well, I think that the rotation, there was fears about Europe. We got kind of overdone with tech being too expensive. And then this week, we really started that rotation back to the pandemic recovery stocks, and rates are rising. Well, of course, all that's completely reversed. But we do think that in the long run, this is a mild positive for the market. We think the Fed will go more on hold, not on hold totally. We're projecting 4 rate increases next year. Now we see only 2. And we don't think this is going to hurt economic growth substantially, because housing is really the key driver. And the fact that we might have lower rates is bullish for housing, keeping in mind that 64% of Americans own their own home. Mm-hmm. So critical driver of economic activity.
So Jay, let me just make sure I heard you correctly. Were you previously looking at 4 rate hikes next year or in the next 12 months? And then what changed today?
Yeah, we were super bearish about inflation, not just in housing, but also energy. There's an energy crisis going on globally because we've, failed to properly manage the energy transition. So the combination of those two things, housing and then energy, we saw inflation, actually the run rate being close to 10% when you mark some things to market like rents, which the BLS doesn't properly calculate. So we were super bearish about that and thought that the market was going to have difficulties next year. But this takes the pressure off the Fed. So we think that, like I said, it could be actually a mild positive for later in 22, where you don't have the Fed, possibly creating a recession to cool off inflation.
But I am curious what changed. I mean, of course, you're seeing oil off 10%, having one of the worst days since April 2020. But does one data point a change make? How much pressure are you really seeing being taken off the Fed?
Well, I mean, there is this implicit assumption that the 31 over 30 variations make the vaccines ineffective. If the vaccine manufacturers next week announce that it's still 70% effective or something like that, then this entire trade could get reversed. But let's just assume kind of the worst case. It is critical. I mean, I think it's somewhat rational for oil to be down 15%. That does take a lot of pressure off on the energy side. I think there still will be inflation, but it won't be as accelerating as quickly. And the Fed's going to be more nervous about growth, despite my comments about housing. So it gives them cover to slow down the rate increases. So that's why I think, particularly for tech stocks, not just because of COVID, because of lower potential rates, that could be bullish, and that should stabilize the market as you get more rotation in tech versus just right now we just have a liquidation. Almost everything's down except a few drug stocks.
Right. Interesting. You're talking about lower rates. It's pretty fascinating. I mean, we came into this week and it has always been the call that yields are eventually on the 10-year going to go to 2%. It seems like we always hit 165, 170, 175, and yields cannot break above that. And then we're back down to a 150 on the 10-year. How are you thinking about yields rising or maybe not?
Well, yeah, now to your point that we think that probably will cap out at 2. Before this announcement, we were at 2 and 2.25. But one of the things that people don't focus on that explains the phenomenon you're referencing is there is now, because of the retirement boom, the aging of the world, really, there's 52 trillion in global pension assets that are actually under-allocated to bonds, about 28%. So we never thought rates were going to skyrocket next year, despite being super bearish about inflation. And the reason for that is that once the 30-year gets over 3, a lot of large pension funds, particularly in the U.S., will rebalance and reallocate, and big buyers of those 30-year treasuries above 3. So we do think that treasuries are range bound and now probably at a lower level, maybe 1.75 to 2 next year. And so, like I said, that's bullish for housing, that's bullish for tech stocks. So it could actually be better for 22, even though it's not great in the short run as we deal with the new variant.
Yeah, lower yields boosting long duration assets like tech. Jay Hatfield, really great to get your perspective here. Infrastructure Capital Advisors Portfolio Manager and Chief Investment Officer.